Listen, what if I told you that 40 million Americans just got a free credit reset on how they pay their student loans, and that reset can help them boost their credit more than they know? And if you stick around to minute 3, I'm going to show you how you can get a financial win off of this information. Now, this comes directly from Forbes, and it says that major changes to student loan repayment advance for 40 million Americans. This is important because as I help people restore their credit and take it to the next level, student loans is one of the big concerns that they have due to the fact that they know that late payments associated with student loans can drop their score. The interest that accumulates if student loans aren't paid are very significant, and sometimes the large student loan amount can affect their debt to income ratio. So these are things that I look at and strategies that I provide when I'm helping people take their credit to the next level so they can position themselves to buy a home or whatever it is that they want to do. But let's talk about these major changes and what they came from, and then I'll just break down how you can benefit and win from this regardless of what you have going on in your credit profile. So it says that the Department of Education clarifies some key details on massive changes that are coming to federal student loan repayment as it advanced new regulations earlier this month. More than 40 million borrowers could be affected by the reforms. The proposed regulation represent the next step in enacting the One Big Beautiful Bill Act that President Donald Trump signed into law last summer. Congressional Republicans passed the legislation on a party line vote. The bill directs the Department of Education to establish regulations that will facilitate the implementation of major changes to various federal student loan programs. Stick with me. The department convened a special rulemaking group called the Reimagining and Improving Student Education, or RISE, committee to review the proposed regulations. The RISE committee met earlier in October and discussed several key regulatory provisions that will fundamentally change federal student loan repayment for millions of Americans under the One Big Beautiful Bill Act. So here's a breakdown, and this is where you want to take notes or screenshots so you can get a better understanding of what's going on. Changes to fix federal student loan repayment plan. So the One Big Beautiful Bill Act makes significant changes to fix federal student loan repayment plans, which are plans not tied to a borrower's income. Currently, there's a 10-year standard plan, a 25-year extended plan, and a consolidation standard plan for up to 30 years. Under these plans, monthly payments are fixed at the beginning of the student loan's repayment term and don't change over the course of repayment. There are also graduated repayment plans where monthly payments start off lower, but then gradually increase over time on a fixed schedule. Under the One Big Beautiful Bill Act, these repayment plans will all be eliminated for borrowers who take out any federal student loan or consolidate existing loans on or after July 1st, 2026. So, if you were one of the individuals who had your payments that started off lower, but then they gradually increased over time, this could be eliminated if you take out new federal student loans. Not that you want to do that, but this is just something to weigh the pros and cons of to determine, okay, is it worth me to get this previous repayment plan canceled by me going into a new loan? Because if so, in certain cases, if your loan was increases, it could put more money back into your pocket and position you for better opportunities for bettering your credit and just getting full control of your finances when done correctly. But let's keep going so we can unpack that a little bit more. Now, when it comes to credit, you paying your balances down helps you. If you have a credit card, one of the fastest ways to get a credit score increase is paying your balances down to less than 5%. And you can see up to 165 point increase just off of that alone. I just wanted to insert that because a lot of people don't realize they can boost their credit just by paying their credit card down and doing it by a certain date. And I had to include that because that is something you need to think about when it comes to lowering your balances overall, but especially when it comes to large balance like student loans. But that's neither here nor there. This is what you want to make note of. After that, the only fixed repayment plan option will be a new tier standard repayment plan that has a term of 10 to 25 years, depending on the size of the loan balance. Now, the Department of Education confirmed during this month RISE committee meeting that borrowers who already have federal student loans and who do not take out new student loans or consolidate after the cutoff date, which again is July 1st, 2026, will maintain access to the legacy fixed repayment options regardless of when they actually enter repayment. So if you do not get any student loans, you will maintain access to the legacy fixed repayment. So if you prefer that, then that's what you need to know. But if you go into a new loan, then you got to understand that the new rules will apply to you. So that's something to make note of. If you know you like the terms that you're currently in, then you may not want to enter into a new loan, in terms of schooling. Not that you were planning to, but sometimes people do it because they have other things they aspire to do and they feel like school may be that avenue to make that happen, to each his own. However, if you do not like your current terms, then would it be beneficial to open up a new federal loan? And then they have to be a monster size loan. It might just be something that flips the switch to put you into a new agreement, remove the old agreement, and see if there's a way that you can benefit from that. I hope that makes sense. Now, based on feedback from negotiators, representing state officials, student loan servicers, legal assistance organizations, the education department clarified within regulatory text that continued eligibility for standard, extended, and graduated is based on the date of loan disbursement, not the date at which a borrower enters repayment. And this came from the Institute of College Access and Success, TICAs, basically in a blog post last week. And it said, during non-binding post-check used to gauge whether negotiators are close to consensus on proposed text, all negotiators had gave language on fixed repayment plans a thumbs up, indicating the committee is likely to reach consensus on these provisions in the next meeting. If the committee reaches consensus on any topic, the Department of Education generally must accept the committee's recommendation. Otherwise, without consensus, the department has more flexibility to implement its own interpretation of the statute. So here's some changes to student loan income-driven repayment plans, which many people are a part of. The income-driven repayment plans is pretty self-explanatory, but basically based on your income will determine your payment. Some people were able to have $0 being paid out, but it was still reviewed or viewed as they were paying it on time because they had low income. Them not making a payment at all showed up as an on-time payment, and it was people who carried that out for years. So let's see what the changes are, because this could have an impact on millions. So the One Big Beautiful Bill Act will also make substantial changes to income-driven repayment, or IDR, and these reforms will have profound and lasting effects. IDR plans allow borrowers to make payments based on a formula applied to their income and family size. Historically, these plans provided a path to student loan forgiveness, typically after 20 or 25 years in repayment. Well, this income-driven repayment plan are also typically required component of public service loan forgiveness, which provides for loan forgiveness after 10 years in repayment while working in qualifying nonprofit or government employment. So if they're doing some of those things, they can qualify them for loan forgiveness if they're doing some type of, public volunteering for nonprofits or government employment, etc. So under the bill, 3 of the 4 existing income-driven repayment plans, so the ICR, the PAYE, and the SAVE, depending on which one you're in, you should know, would be sunsetted by July 1st, 2028. The IBR plan, which includes an older version and a newer, more affordable version for borrowers who first took out loans after July 1st, 2014, will remain intact with some modifications. The legislation will also create a new plan called the Repayment Assistance Plan, or RAP, in 2026. RAP may be more expensive for lower income borrowers and for those who have been enrolled in Save or Pay or RAP, and RAP also will have a 30-year repayment term before a borrower can qualify for student loan forgiveness, which is far longer than any existing IDR plan. But RAP also will have a principal and interest subsidy that will stop future balance growth, which is a unique benefit. So some people don't want future balance growth to take place when it comes to interest and things of that nature. So sometimes they consider that a benefit. However, the time frame is a little bit longer, and you have to know which one you're currently enrolled in so you can see which one is likely to have an effect on you and the benefits of the things that can come from it. Now, let's wrap this thing up. There will be a period of up to 2 years during which these payment programs can all coexist, but by July 2028, the only 2 remaining IDR plans will be IBR and RAP. Current borrowers in repayment would maintain eligibility for IBR, but if they take out any new loans or consolidate on or after July 1st, they would lose eligibility for IBR and would only be eligible for RAP. So make sure you keep this in mind. And if you have children, keep this in mind, because them taking new loans could put them into the new plans, and you got to know, is that a benefit or not, based on what your goals are, based on your circumstances. Is it a benefit to go ahead and open up a loan so you can get out of the old particular programs that you may be a part of? That's up for you to decide. I just want you to know what changes have been made so you can determine which one is right for you. And in the RISE committee meeting earlier this month, the Department of Education clarified some key elements of the student loan repayment reforms for IDR plans that were not expressively clear for the statutory text of the One Big Beautiful Bill. For example, the department, he confirmed that the borrowers who select RAP will not necessarily be locked into that plan if they remain eligible for IBR. Those borrowers will be able to switch back and forth between IBR and RAP. And there's more details that need to be dove into so you can see all of the nuances and how it would best benefit you. If you want a video like that where I break it down, just let me know. But I just want you to understand some of the nuances because you may be already a part of these plans. And the thing is, if you start a new loan, it might open up some opportunity for you. Because some people don't like the current program that they're in because their payment plan skyrocketed. The amount that they were paying doubled, tripled. I saw this happening. You know, the interest started kicking in like crazy. Different people had different experiences. So you just got to figure out what's right for you. The Department of Education also clarified that for existing Parent Plus borrowers to be grandfathered into the IBR, they must first consolidate their loans before July 1st, 2026. So this is going into a new loan or consolidating, basically tying them all together and having one payment that you're paying towards, has to be done before July 1st, 2026. So this gives you a little runway, and you heard it here, so you can decide which one is right for you based on your situation. Now, I'm of the belief that college is not as beneficial as it used to be unless you have certain things that are going for you that college is a necessity. It's certain things that are kind of gatekeep industries that require some type of college or learning, and that's usually the medical field, spread all across the board. But there are certain times that network is going to be a big key, and you getting in a college environment, creating that network. But if you go in there with some type of skill, now you can also be in college, but also somewhat have an entrepreneurial piece that allows your college experience to also be a profitable one as you go down that journey of these, the collegiate journey, basically. So it's all up to you. So in conclusion, it said clarification on the student loan forgiveness, different things that are taking place. I just want you to understand that it's a lot of things coming down the pipeline, and you need to understand what's going to be best for you and your family or your children. And it says right here, some student loan borrowers will need to switch plans. You have to understand which plan you're in so you can determine if you need to switch plans, and if so, when do you need to do it by. Now, it's important to know that the proposed regulations to implement the student loan repayment changes under the One Big Beautiful Bill are not all finalized. You just got to be in the know early so when it does take effect, you're in the best position versus reacting to what has already changed. The conclusion for the first RISE committee hearing and the tweaks made to the proposed regulatory text represent the first major step in advancing the new rules. In a few weeks, the committee will hold the vote, and the department allowed negotiators to submit proposed amendments until October 10th, 2025. So that date has passed. So a lot of this stuff can take effect. So you just have to stay in the loop. The full committee will reconvene for its final work period on November 3rd through the 7th of 2025 to further discuss these issues and vote on ED's proposals. If RISE committee members reach consensus on the proposed changes to student loan repayment and loan forgiveness, then the Department of Education will finalize and enact those regulations. If there is a disagreement among the committee members, the department will have a freer hand in establishing the new rules in accordance with its own interpretation of the statutory text. So at the end of the day, you have to take your finances in your hands and see what's best for you. If that means doing a consolidation, okay. If that means getting into a new federal loan, okay. If that means staying in the one that you're currently in, okay. If that means cleaning up your credit in a way that allows you to remove it off of your credit report altogether, not excusing or removing the obligation, but just not showing up on your credit report so that it's not a factor when you're trying to qualify for certain things, okay? But you have to figure out what works right for you and your family. And once you determine what works right for you and your family, take action. And if you need my assistance on credit restoration, links down below. Salute.